Sometimes a single number comes along that tells an incredible story about the economy. This week, we got one of those numbers. It's so big, it's honestly hard to even get your head around. And it points to this fascinating paradox right at the heart of the US financial system. So let's get into it. Okay, just look at that. $602 billion. I mean, it's almost impossible to really visualize what that looks like, right? So let's try to put some context to it.
Now, this isn't the value of some big tech company or the output of a small country. Nope. This is pure borrowed cash. Money that the United States Treasury had to go out and raise from investors. But the really staggering part isn't just the amount, it's the time frame. Yeah, that's right. Over $500 billion borrowed in just 4 days, and this was during what the market considered a relatively quiet pre-holiday period. It just makes you wonder, why on earth does the government need to borrow this much this often?
All right, so let's dig in here. Where did this massive number even come from? We're going to break down exactly what the government sold in 9 different auctions to raise that incredible sum. So as you can see, the borrowing was split into 2 big buckets. The huge majority of it, $483 billion, came from Treasury bills. You can think of those as really short-term IOUs, stuff that gets paid back in just a few weeks or months. The rest, $119 billion, was in longer-term debt like notes and bonds. But this massive weekly number, it's really just a symptom of a much, much bigger issue.
Okay, so to really get why the US needs to borrow over $500 billion in what's supposed to be a slow week, we gotta zoom way out and look at the total pile of debt that's already on the books.
And there it is, the total US national debt. We're talking more than $38 trillion. It's a number that's so huge, it almost loses all meaning, unless you look at how fast it's moving.
And that's the thing, the speed here is just staggering. In the last year alone, the debt has jumped by over $2 trillion. So that's the backdrop for a week like this one. Some of this new borrowing is for new spending, but a whole lot of it, it's basically like taking out a new credit card to pay off an old one that's maxed out.
So you might be wondering, who exactly do we owe all this money to? Well, it's mostly split into 2 groups. The biggest chunk is held by the public. That means investors, pension funds, even other countries. The rest is kind of weird. It's money the government basically owes to itself, in places like the Social Security Trust Fund.
Okay, and this is where things get really interesting. Because while all this massive borrowing was happening, something else was going on in the economy that should have made it cheaper for the government to get all this cash. The U.S. Central Bank, the Federal Reserve, the Fed, they actually went and announced they were cutting their main policy rate. This is the big one that's supposed to influence borrowing costs for pretty much everyone. And the logic here is pretty straightforward, right? When the Fed cuts rates, your mortgage is supposed to get cheaper, your car loan gets cheaper, and you'd think the interest the government pays on its gigantic debt should also go down. But that's not what happened.
And here is the paradox in a nutshell. You have the Fed pushing with all its might to make borrowing costs go lower. But the market, the actual investors buying all this government debt, they turned around and pushed long-term rates higher. I mean, the interest rate on government bonds actually hit its highest level in months right after the Fed's rate cut. How does that happen?
So what in the world is going on here? How is the market just completely shrugging off a move from the most powerful central bank on the planet?
Well, the answer is basically a giant tug of war between 2 massive forces, what the Federal Reserve is trying to do and what the market is afraid of.
And really, it boils down to this. The market isn't so much focused on the Fed's latest move. Nope. It's way more worried about 2 other big things: the risk of inflation down the road and this idea of supply fears. So what exactly are these supply fears? Well, it's just classic supply and demand. The worry is that the US government is trying to sell so much new debt week after week after week that there just aren't enough buyers willing to snap it all up at the current low interest rates. So to get people to buy it all, you have to offer them a better deal, which means a higher interest rate for them. So to put it another way, investors are looking at that absolute mountain of debt and basically saying, you know what? This constant flood of new bonds is a much bigger deal to us than the Fed's little rate cut. They're demanding to be paid more to lend the government money for a long time. And you can see this trend playing out so clearly when you just look at the numbers. Go back a decade. The government sells $21 billion in 10-year notes and pays just over 2% in interest. Flash forward to this week, they have to sell almost double that amount, $39 billion, and they have to pay nearly double the interest rate to get it done.
I mean, that quote just says it all, doesn't it? It's a really stark picture of how the costs of funding all this debt are just compounding. The amount is growing, and the rate on that amount is growing right along with it.
And that brings us to the really crucial takeaway from all this. We might be in a whole new ballgame now, where the simple mechanics of supply and demand for U.S. debt are actually a more powerful force on long-term interest rates than even the Fed itself.
And just to really let that sink in, let's look at one last number. $2.2 trillion. It's another one of those numbers we hear so often it starts to lose its shock value, but it really shouldn't. Because that is how much that mountain of debt grew in just the last 12 months. That's the supply the market is getting so nervous about, and it's why a single rate cut from the Fed can just get completely drowned out by all the noise.
And all this leaves us with a really big, looming question, doesn't it? If the market keeps demanding higher and higher interest rates to soak up this growing supply of debt, and that supply shows no signs of slowing down, what happens then? What does that mean for the future of the economy, for the rates on everything from your mortgage to your car loan? It's a massive paradox that was on full display this week, and honestly, it's something we're all going to be watching for years to come.